Welcome to Markets in a Minute. My name is Austin Duke. I'm financial advisor and chief investment officer for Diamondback Financial Services. We are an investment advisory firm focused on clients who recognize the need for solid investment advice, who don't want to invest on their own, but still want to be educated through the process. This is the Monday, August 4th, 2025 edition. Let's get started. All right, we'll start by looking at the stock market as measured by the S&P 500. This is an index of the 500 largest companies in America. Stocks will go up and down on a daily basis for a variety of reasons, and our job is to figure out what moves we've seen, why we've seen them, where we think we're going from here. For the prior 2-week period, the stock market was down about 0.93%. Not a whole lot going on to talk about of consequence up until Wednesday afternoon. The Federal Reserve voted to have no changes to interest rates, and Jerome Powell in his press conference basically said, we're not in any hurry to cut in September either. And then some more economic data coming out and other things that we'll talk about in a minute that led to the market dropping off here at the end of the week that has us a little bit concerned. Next, we'll look at interest rates as measured by bonds issued through the U.S. Treasury Department. Again, interest rates we think are the preeminent measure of investment risk and are factored into every investment calculation, including stock valuations. Generally speaking, if interest rates are coming down, stocks will be going up. And if interest rates are going up, stock prices will come down. Over the prior 2-week period, we saw a shift down in interest rates. So we got the rate listed over here on the left, and we've got different maturity lengths down here on the bottom axis. Each of these dots represents an interest rate for a given maturity. We consider this the short end, right? Short maturity end of the interest rate curve, then the medium term, and then long term out here on the right. Short term, not a lot of change, right? Federal Reserve didn't make any changes to the Fed funds rate. So those are all pretty much the same as they were 2 weeks ago. But between medium and long-term rates, those are coming down. And we anticipate that it's not an exact one-for-one correlation. As rates come down, stocks don't go up necessarily on the same day. That can happen, but it's more of a long-term impact. Again, there were some things that happened on Friday. Most of the change that we saw in interest rates all happened at the end of this week, which we'll get into in a minute. But suffice it to say that we basically had less than a 50% chance for an interest rate hike or sorry, not a hike, interest rate cut. After the meeting on Wednesday, we still were at below a 50% chance, but because of the economic data and some other things that happened at the end of the week, now we are almost expecting a cut in interest rates in September, and then at least one more by the end of the year. Maybe this will become closer to 3, and that we'll get that third cut of 0.25% by the end of the year. All right, for our investment implications and expectations portion, we're going to talk about some of the economic data and news that happened here at the end of the week that really overshadows everything else that we did over the 2-week period. We keep a list of news and events and economic data throughout a 2-week period. We keep notes so that we have an idea of what we're going to say when we do these. But what happened over the last couple of days has us feeling like that's all irrelevant at this point. So we'll start with GDP. This is gross domestic product. This is how we measure the growth of our economy. And this came out on Wednesday, the 30th of July. And over here on the right, you can see 3.0% on an annualized basis. Now, if you look at the first quarter right next to it, you'll notice that this is pretty much a mirror image of what we had in the first quarter. And most of that is driven by the imports that we were having in the first quarter in anticipation of tariffs that were going to be implemented in April. Ultimately, those got delayed, so we didn't see the same activity. It was almost the exact opposite of activity in the second quarter that we had in the first quarter. If you average those two out, not a lot of change, not a lot of growth in our economy for the first half of the year. All right, if we go next to a composition of our economy. Over here on the right, this is the contribution from housing, from business investment, federal, state, and local government spending, And by and large, the largest contributor is consumption, right? Personal consumption by people like you and me. How are we spending our money? What are we spending it on? And that is what ultimately drives our economy. So when we are doing our investment analysis and where we want to put your money in anticipation of growing that money, a lot of it is focused on the consumer. So number one, is the consumer healthy? Are they employed? Are they bringing in money? And then are they spending it? And how are they spending it? Um, a lot of people are spending money on homes, rent, mortgages, car loans, student loans now have restarted. So how much money do people have left, and what are they spending it on? And are they being judicious about how they spend it, et cetera? These charts are more on the employment side. So we've got JOLTS, that's job opening and labor turnover surveys. We've got job openings by sector. We've got job quits and job layoffs, right? We keep track of how many job openings there are out there, how many people are quitting their job, which could be because they're taking another job or retiring or just leaving the workforce, right? So there's quits and then there's layoffs, people who are being let go from their position. Back in 2021 and 22, we had up to 12 million job openings, and those have been dwindling over the past several years, and now sit at about, we'll say, 7.5 million job openings. So fewer jobs available. People who are quitting their jobs, almost 4.5 million people were quitting and leaving their jobs, and then now we're closer to 3 million. So it suggests confidence in the market. If I'm going to quit my job because I'm taking another job or because I don't need to work or whatever the case may be, if we see more people quitting their jobs, that tells us that there's confidence that suggests a good economy. Okay. And then layoffs, obviously, if people are getting let go, that's a sign that companies are scaling back and cutting employees because that tends to be a large expense for businesses. Now, not a huge significant change in layoffs, but we were laying off fewer people back in 21, 22 than we are now. And part of that could be some what we would say maybe is PTSD from COVID. So many people got let go when the economy got shut down, and then it was so hard to get people to come back to work that companies may be reluctant to lay off a lot of people. Moving on, now we look at our weekly jobless claims and we look at continuing jobless claims. Okay, so people who are being let go, who are being laid off, and are filing for unemployment benefits, right? We can keep track of that. So coming out of the COVID pandemic, we saw a nice decline back to what we would call a pretty normal level of jobless claims, right here in the 250,000 range. Okay. We've talked about seasonality right around the holiday season, the temporary workers that get let go. But if we adjust for seasonality and we take moving averages of these numbers, not a lot that we're concerned about. Now, on the continuing claims, coming out of the COVID pandemic here at the end of 2021, we were at 2.8 million. We were finally able to get people to come back to work. We got continuing claims down to about 1.4 million. We cut that in half in about a 6-month period of time. But ever since the summer of 2022, we've been seeing a gradual increase in continuing claims up to almost 2 million now. We're about 1.95. So this is suggesting to us that not a lot of people are being laid off, not in droves, right? Like this isn't a massive recession where people are just getting laid off left and right, but we're seeing a pretty steady flow of people being let go from their jobs and are having a hard time finding work. Okay, so that tells us that it's not a perfect job market, but it's not on life support either. Okay, and finally, on Friday, we got our payrolls report, our non-farm payrolls report that comes out on the first Friday of every month. And this tells us how many jobs were added to the economy in the prior month. Now, I don't know all that goes into this calculation, but the Bureau of Labor Statistics, they're the ones in charge of it. And they'll put out a number on the first Friday of every month. I assume that it's not an easy task to figure out how many jobs were added for all these different sectors across the entire country, but they will also revise prior months when they release a new number. And in this case, we got a $73,000, sorry, 73,000 jobs were added in the month of July. And if we look over at the different sectors, it pretty much all came from education and health services. Why? Probably because teachers are going back to work and they're back on the payrolls. But the healthcare sector tends to always have jobs added as well. But if we look at all the other sectors, you add them all up, you're basically at a zero growth other than education and healthcare for the month of July. The numbers for May and June were revised down to 19,000 and 14,000 jobs. The job market is pretty much stagnant at best. If we think about GDP for the first half of the year, from the first quarter to second quarter, we average those out, it's pretty much stagnant. So President Trump ended up firing the commissioner of the Bureau of Labor Statistics yesterday on Friday because maybe we'll call it a conspiracy theory, but he referenced back to August of last year when the Bureau of Labor Statistics revised down the number of jobs created in 2024 by 818,000. So for the 12-month period, they had initially reported 2.9 million jobs were created, which is fantastic. That is a robust economy. But their revised number was 2.1 million, which is solid growth, but it's not robust. And President Trump, obviously running for election last year, said it was a conspiracy, said it was deceptive, trying to help the incumbent party get reelected, because the economy tends to be one of those things that if people are happy with the economy, the incumbent tends to win. And President Trump obviously not wanting the economy to look well so that he could come in and save the day. I guess he forgot that person was still the commissioner of the Bureau of Labor Statistics until yesterday when they revised down these numbers, and then he fired him to get back at him. But you can see that we've really stagnated here in the summer. And if the Federal Reserve is meeting and making interest rate decisions based, they say they're data dependent. If they're making decisions based on payroll numbers that initially are good but turn out to not be so good, then they are going to be too late. They are going to be behind the ball. So we do need good data in order for us to make good decisions with how we're going to invest. So it's not just the Federal Reserve that's data dependent. We are too. So if we think that the economy is going well, then we're going to be a little bit more aggressive with the investments. We're going to say, look, the economy is growing. We're going to invest because people are spending their money. They got jobs, blah, blah, blah. And if reality is no, like we're on life support, or we're getting to that point where we might need to be put on life support, then we may want to invest differently. So all we're trying to say is at this point in time, here, August of 2025, there is a chance that 6 months down the road, a year down the road, the National Bureau of Economic Research will say a recession started in August of 2025. We don't know that for sure. And just because it's a recession doesn't mean it's going to look like 2008, 2009, or 2020. It could just be that we flatline. There's not a lot of growth. We stagnate, and it takes some time, maybe a couple quarters, for things to get going again, especially when we now have tariffs that have been implemented or will be implemented this week. We just wouldn't be surprised if the economy kind of takes a breather before we start seeing additional growth. The only I don't know what the word is. The Magnificent Seven, the companies that are invested in artificial intelligence, they could help buoy the economy just by themselves because they are spending money amongst themselves. They're buying chips, they're investing in artificial intelligence, right? They're spreading the love around. They don't necessarily need the consumer for them to have large capital expenditures and grow their artificial intelligence investment. And then it just becomes, what does the consumer do? Like, we're obviously going to pull back, but where are we still going to spend our money? We're still going to spend it on healthcare services. We're still going to spend it on, maybe some vacations. It's just where are those vacations going to be, and are the hotels going to benefit? Anyway. So that's for us to figure out. But we are going to be a little bit more defensive at least for the next 6 months. We feel there's enough evidence. Like we've kind of felt like things haven't been going super fantastic, and the data has suggested that things are better than they really were, and now we're kind of vindicated in that. Um, so, so we're just saying we're going to be a little more defensive. For those who are retired, we're already defensive enough. Like we've got you taken care of. If you're approaching retirement, we're going to be a little bit more defensive. And for those who are aggressive because they're younger and they're adding to their accounts, we'll probably continue to use those funds to buy in if and when the market does decline more than it has. But we're just trying to at least set the stage and let you know that things are not as good as we thought they were, and we can make a case for them to get a little bit worse. And we're hoping that things don't get a lot worse, but we're going to make some changes to investments just in case things do get a lot worse. So I think we'll leave it at that. Okay, so I need to have something positive for a final note. I have two boys that are teenagers. One's 17, one's 15. And my 17-year-old, he got a learner permit, and we've been trying to get him his driver license, and he's been taking his time. And so much time that when we went to do the driving test, his permit expired, and they wouldn't let him do the driving test until he had a valid permit. And for whatever reason, he took that test 10 times before he finally passed it again. And his younger brother went with him for the first time to take it and get his permit. And so it was really fun to have both of them pass on the same day at the same time. And now we can get the older brother his license, hopefully, and the younger brother can start learning how to drive. So I think for the final word, it's persistence, right? We come in, we do the best we can with what we've got, and if we don't get it right the first time, we try again, and we keep coming back, and we don't give up. And we're grateful for all the patience you have with us. We're grateful for the opportunity that we have to be good stewards of your money and your investments, and working hard to do our best and make sure that we don't put more risk in your portfolios than we need to, and that we're able to identify these potential shifts in the economic winds so that we can adjust our sales and keep things going. So, and my kids are going back to school. I couldn't be more thrilled. So, have a good week. We'll check in soon. And if you have questions, please reach out, let us know. And otherwise, we'll see you soon.